Hello and welcome to our presentation on foreign exchange markets. I'm Dan and I will be joined by Stephen and Jane to find some key indicators to make appreciations as to what directions exchange rates between both the Australian dollars, US dollars, and Australian dollars, Japanese yuan pairings will look like in the future. Well, in this presentation we'll be analyzing two different currency pairs in order to speculate as how they will do against each other in the market. And then we will be outlining which currency in each pair will appreciate and depreciate against each other. To do this, we will have a look at some key indicators which determine the supplier and demand levels of the given currency and now how they do against each other as a result. Here, let me first start by saying that overarching mechanism by which a country's exchange rate is determined are the level of supply of the currency on the market and the level of demand for the currency. These levels are determined by the market force and the equilibrium which determines on the exchange rate as shown on the y-axis and the quantity of the currency on the x-axis. The first point to consider is that the level of demand is inversely related to the value of currency compared to another currency. So naturally, when the level of demand is higher for the currency, the value of the currency related to another with lower demand drops. Secondly, the level of supply is directly related to the price of currency. And so when there is higher supply, the exchange rate of the currency with higher supply rates against the currency with a lower supply. The key economic indicators that we'll be looking at in our analysis include the relative inflation rate and the exchange rate expectation, and the last one is relative interest rate.
In our analysis on the future of the AUD to USG exchange rate, let us first observe the interest rate that each country's central bank has implemented. This is the first step of a process to understand the real interest rate, and we need to have a look at the inflation rate and the nominal interest rate. According to the RBA website, as of the 7th of September 2016, the current interest rate is 1.50% in Australia. In the United States, currently the Federal Reserve is holding their interest rates at 0.5%, and this is according to the Federal Reserve website. So before we combine the inflation rate and interest rate together to determine the net effect of the two, let us first discuss the effect of relative inflation rates without the influence of relative interest rates. If there is an increase in the inflation rate in Australia, for example, this would mean that exports from Australia priced in AUD will be more expensive relative to a country with lower levels of inflation that have prices in a different country in their own currency. Therefore, goods priced in AUD would be less competitive compared to those. This would mean that there'd be less overall demand of AUD, shifting the demand curve to the left. The other effect is that there would be an increased demand for cheaper imports, therefore leading to an increased supply of AUD to the market, shifting the supply curve to the right. The net effect of these two processes that come about due to higher inflation of AUD against another currency is a depreciation of the Australian dollar if the other currency has a comparatively lower inflation rate. Just looking at the interest rate in isolation, the aforementioned figures provided by the RBA would suggest that the Australian dollar would appreciate against the US dollar as the effect of the relatively high interest rates in Australia compared to the United States mean that capital inflow would be relatively higher as investors get a greater return on investment or investing and holding investments in Australian dollars. This increases the demand of Australian dollars against the level of demand for US dollars. Furthermore, investors would be much more willing to keep their holdings in Australian dollars, which therefore leads to a lower supply. However, we must consider what the real interest rate is, and now that we've looked at the nominal interest rate and the inflation rate, we can determine this. An increase in the real interest rate leads to an appreciation of the currency, whereas an increase in the nominal interest rate does not lead to an appreciation of the currency. The real interest rate can be found out by taking into account both the inflation rate and interest rate. This is an important piece of information because if the nominal interest rate does not exceed the inflation rate, instead of seeing an increase in capital inflow, a decrease in capital outflow, and the appreciation of the currency, we would instead see the complete opposite, as there is no real increase in the interest rate, as the inflation rate offsets it, effectively acting as a decrease in interest rates and resulting in net capital outflow as imports become cheaper. According to the RBA, at the time of the creation of this presentation, the inflation rate for the Australian dollar is 1%. According to the World Bank website, the latest inflation rate figure for the United States is 0.119%. Taking these figures into account, it is evident that Australia has a 0.50 real interest rate, whereas the US has a real interest rate of 0.38. From here, we can definitively say that Australia makes a better investment environment compared to the United States, and that we would expect that there be more demand and less supply for Australian dollars compared to US dollars. Therefore, the AUD would be expected to appreciate against the USD. In terms of the AUD to Japanese yen exchange rate, as outlined previously, the RBA currently holds an interest rate of 1.50% with an inflation rate of 1%. Leading to a real interest rate of 0.50%. The Bank of Japan, as of 2015, holds interest rates at 0.41%, with an inflation rate of 0.79 the same year. As for the exchange rate between Australian dollars and Japanese yen, this effect of negative real interest rates would lead to a higher demand and lower supply of Australian dollars compared to Japan's situation, meaning that investing in AUD is a better option for gaining a greater return on investment. Therefore, the value of Australian dollar is said to appreciate against the Japanese yen.
Another key indicators that we'll look at to ascertain what will happen to exchange rate between AUD and USD is the exchange rate expectation. Investors can amplify the effects of any movement of currency exchange rate, especially if rumors take hold on what will happen to an exchange rate, or more specifically, whenever central banks change interest rate or announce they are likely to change the interest rate or inflation rate changes. On their own, these factors will not exert as great an influence on exchange rate between the AUD and USD. However, in a situation in which the AUD is appreciating against the USD because of the factors as outlined above, the appreciation of AUD against the USD would be helped along as investors see that the real interest rate in Australia is higher than in the USA. They would buy Australian dollars just based on this expectation alone, which would lead to an appreciation of AUD over the USD. Investors' expectations are not only based on what the central bank is doing and what inflation is doing, but also the recent data on the exchange rates. Investors know that AUD will appreciate against the USD based on the facts that it has been doing so lately, particularly very recently, and continues to do even despite the facts that RBA reduced the interest rate on 2nd of August, like here, as shown by this data from the IMF. Although inflation did come down from RBA's target, as Japan has been on a deflationary trend for a very long time now, and continues to go further down into deflationary territories and real negative interest rates. Spending in Japanese economy remains slow due to the downward trend in the interest rate. Investors would expect that Australian dollars would continue to appreciate against the Japanese yen because individuals investors would expect that investors as whole would be more willing to invest in Australian dollars than Japanese yen. So they themselves would more move the crowd and do the same thing, putting even more downward pressure on Japanese yen and appreciating the value of Australian dollars relative to Japanese yen JPY. Furthermore, recent historical exchange rates between AUD and JPY pairing have been investors expect that due to the deflation that Japan has been eager in recent history, and the Bank of Japan's continuous pursuit ultra low interest rate, as a natural consequence of the Japanese yen will continue to depreciate against the Australian dollar. The further exchange rate of AUD and JPY will almost certainly be an appreciation of the Australian dollar against the Japanese yen. Again, owing to the long history of real interest rate decrease and the expectation that this trend will continue, as long as there's deflation of and sluggish economy that results from said deflation. In closing, this is our view. The AUD is likely to appreciate against both the USD dollars and Japanese yen in the next 3 to 6 months. Thanks for watching this presentation. We do hope it has been helpful in informing you future investment decisions. Thanks.